Money matters now, and the JSE is weaker in midday trade along with its global peers. Investors continue to evaluate the risks of inflationary pressures and the advance of the Omicron variant. Against the backdrop of reduced monetary stimulus, portfolio manager at FNB Wealth and Investments, Wayne McCurrie, joins us now to talk us through the latest developments in the world of business. Wayne, thank you very much for joining us this afternoon. Let's start with a sense of how the local market index opened in early trade.
Well, look, I mean, the market, as you said, the market is down on the back of fears overseas about inflation in the USA in particular, and that was on the back of some federal bank authorities in America sounding a lot more bearish about inflation than the chairman sounded the other night. So I think we're going to sit with this backwards and forwards movement in the share market for the next couple of months until we actually work out what has happened to inflation.
Oil prices eased for a second session today amid growing concerns that Washington may soon act to cool prices. Let's talk through some of the elements driving commodity moves so far this afternoon.
Well, look, I'm surprised the oil prices stayed so high because a lot of other commodity prices have come off the boil. And, of course, we do know that the oil price is an artificial price because it's maintained up at those levels by restricting supply, OPEC plus restricting supply. So I hope that this downward trend continues. But unfortunately, I don't think we'll see a big decrease in the price at the pump this month, despite the fact that the rand's been relatively strong for the last month or so.
Let's take a look at the year that will be. What do you perceive as some of the key growth risks to the country's economy?
Well, look, this next year is going to be tough because it's going to be dictated by what happens overseas with U.S. inflation and U.S. interest rates. If inflation in America falls towards, let's say, 2 or 3% by the end of the year, I think we'll be okay. Remember, it's currently at 7%, and it's at 40-year highs in America. As long as inflation falls, interest rates will still go up, both here and in America, but they won't go up dramatically as long as inflation falls to, as I said, the 2 or 3% level. If it stays at 7%, I think we will see a dramatic fall in share markets, and also the country's worldwide economy may in fact go into some form of recession because interest rates would have to rise dramatically to counter that inflation. So the outlook for this year, unfortunately, is not good as far as markets are concerned. But as long as inflation falls to the range expected, then I think we'll be okay. And I think it's the same for global economies. We'll be okay as long as interest rates don't go up, more than 2 or 3% over the next year or so.
Local trade is already hitting the ground running or reaching new highs. What are your two stocks to watch out for this year?
Look, I mean, it's really nice that we've had a bull market and the share market is sitting at record highs. It's difficult to say which sector is going to do well. I still think the South African shares, in other words, the banks and the retailers, show reasonable value. Certainly the banks have had a very strong run over the last 6 months or so. They're of the best performing sectors in the market. So I still think there is some value there. Commodity shares look a little bit expensive for me. I mean, they've fully recovered from the bit of weakness we saw towards the end of last year. So I think the opportunity does lie in South African stocks, good South African orientated companies, as I mentioned, the retailers and the banks.
Wayne McCurrie, portfolio manager at FNB Wealth and Investments. Thank you very much for your time this afternoon.